Did you ever feel so bad inside?
Random objects, so random objects, so random objects, so random objects, so. With your host, Sasha One, with your host, Sasha One.
Good evening, everyone. Welcome to Random Budget Show. So, today's episode, we will talk about MIA bylaw with our special guest, Mr. Anwar. So, Mr. Anwar, please take a seat. Mr. Anwar, can you explain a little bit about MIA bylaw in a way that people can understand?
Hello. Okay, let me tell a little bit about MIA bylaw. MIA bylaw sets the standards of professional ethics and conducts for audit members in view of the responsibility to their clients and the public. These laws are used to ensure compliance of fundamental principle and conceptual framework of auditing. Let me give a summary on MIA bylaws. MIA bylaw consists of two parts. Part 1 is on bylaws on professional ethics. It consists of Part A, general application, Part B, professional accountant in public practice, Part C, professional accountants in business. But in this episode, we will only discuss on Part A and Part B. On the other hand, Part 2 is about bylaws on professional conduct and practice. In Part 2, it consists of Part A, all professional accountants, and Part B, members in public practice. But I will only talk about Part B, members in public practice.
Next, Mr. Anwar, what can you explain regarding Part A, general application?
Okay. Part A is a general application which consists of 6 main sections. Section 100 will explain about fundamental principle and conceptual framework, where Section 100.1 gives a brief explanation about integrity, objectivity, professional competence and due care, confidentiality and professional behavior, which will be discussed in more details in section 110 to 150.
So, would you explain further regarding section 110 to 150 to us?
Of course. Section 110 is about integrity. The principle of integrity is compulsory for professional accountant to be straightforward, honest, fair in dealing and work in truthfulness. On section 110.2 stated that professional accountants shall not knowingly be associated with reports, returns, communication or other information if they believe that it contains a materially false or misleading statements, contain statements or information furnished recklessly or omits or obscures into required to be included where such omission or obscurity would be misleading. Professional accountants should avoid from those type of information. Next will be the section of 120. Objectivity, which imposes an obligation that all professional accountants must not compromise their professional or any business judgment because of bias, conflict of interest, or the undue influence of others. Section 130 stated that professional accountant shall not accept any appointment if he or she cannot confirm their roles competently. They need to maintain knowledge and skills on the level that they can perform their service and to act accordingly to the standards. Section 140 is about confidentiality. As a professional accountants, they should not disclose any information regarding the firm to outside without proper authorization unless there is a legal or professional rights to disclose. Other than that, they also need to refrain themselves from using confidential information for their personal interests. Last but not least is Section 150, Professional Behavior. It imposes an obligation on professional accountants to follow relevant laws and regulation and avoid any act that may discredit this profession. Section 150 also tells us about the way how we should advertise, marketing, and promoting ourselves in this field of work. Such advertisement should be professionally dignified and in good taste, and also carried out in accordance with relevant legislation. One should not make any exaggerated claims for the services that they can offer, qualifications they possess, or experience that they have gained. Other than that, they shall not make any comparisons between the work of others.
Yeah. Okay.
Okay, enough with part A. Now let we enter into the part B, which said here we'll discussing about professional accountants in public practice. Mr. Noir, can you tell us what is exactly being taught in part B?
Alright, this part B is actually the continuation of part A. This is because part B basically describes how the conceptual framework contained in part A applied to certain situations to professional accountants in public practice.
It looks so interesting, but I'm sure it's hard to apply those frameworks in the public practice life. And as per what you have said just now, it is indeed over many threats. Can you explain any types of threats?
There are 5 types of threats being listed in MIA by law, which is self-interest threat, the threat that financial or other interests will inappropriately influence the professional accountant's judgment or behavior. Self-review threat, a threat when professional accountants does not appropriately evaluates the result of the past judgment made or service performed. Advocacy threat, the threat that occurs when the professional accountant is being asked to promote or represent their clients, which can cause bias. Familiarity threat, threat due to long or close relationship with the client or employer. And lastly, intimidation threat, the threat that a professional accountant will be deterred from acting objectively because of actual or perceived pressures.
Wow, there's a lot of threats, huh?
Yes, it's true. And since there are a lot of threats which have been told under section 200, surely we have to come up with a lot of safeguards too.
Can you briefly explain about the safeguards that being offered for the threats?
Basically, there are 3 types of safeguard. First one is that is created by profession, legislation, or regulations. Secondly, it is created in the work environment and divided by 2, which are firm-wide safeguards and engagement-specific safeguards. And the last is the safeguards that is created by client's procedures.
That's all for section 200. Now we enters into the new section in part B, which is section 210. Starting on this section, it will be one occasion as example based on each section, and there will be threats and possible safeguards on that particular occasion. So, Mr. Noir, can you tell us more?
Basically, section 210 is about professional appointment. It has three different types in an appointment of a professional accountant, namely client acceptance, engagement acceptance, and changes in professional appointment. Each of these type offers different types of threat.
Thus, each of it also has its own safeguards.
Correct. Let me explain one by one. For clients' acceptance, possible threats will be whether the client being involved in illegal activities or not. Thus, its safeguard is gaining knowledge about client's background activity by the professional accountant. While for engagement acceptance, professional accountant will be facing a threat where they have to determine whether the acceptance will contradict the fundamental principles or not. The safeguards will be to understand the nature of the client's business, the complexity of its operation, or the nature and scope of the work to be performed. Lastly, for changes in professional appointment, the threat to professional competence and due care when accepting engagement because of lack of facts and information. The safeguard for this threat is to have a direct communication with the existing accountant in gaining the facts to decide whether to accept or reject the engagement. Next, we will move on to section 220, which is conflict of interest. In conflict of interest, there is a threat of objectivity issues may arise when a professional accountant competes directly with the client or by having a joint venture with client's competitors or by any other similar arrangement. So the safeguards for this threat is to ask for a consent by informing all the relevant parties regarding the respective interests which are in conflicts. In section 230 is second opinions. The threat in second opinions is that there is a professional competence and due care, since the professional accountant might be making an opinion based on inadequate evidence or facts as per existing accounting. So the safeguard for this threat is to seek for the client's permission to contact with the existing accountant and describe all the limitations surrounding any opinion in communication with the clients. But when the client refused to communicate with the existing accountant, professional accountant needs to decide whether to provide the opinion or not. Section 240, fees and other types of remunerations. On fees, threats in fees is the self-interest and professional competence and due care threats when the fees quoted is very low, that makes the engagement in accordance with applicable standards is hard to perform. The safeguards for this threat is to make the client aware which fees are charged and which services are covered by quoted fees. Contingent fees. The threat is self-interest threat to objectivity which happen because of the nature of engagement which might be got no assurance. The safeguards for this threat is to make an advance agreement with client as to basis of remunerations. Next is referral fees or commissions. The threats for these fees is the create of self-interest threat to objectivity and professional competence and due care when the client requires specialist services which are not offered by an existing accountant. The safeguards is to disclose to the client and any arrangement to pay for a referral fee to another professional accountant for the work referred. Section 250 is about marketing public practice services. When a professional accountant solicits new work through forms of marketing, there may be a threat to compliance with fundamental principles. For example, a self-interest threat is created if services that are marketed in a way that is inconsistent with the principle. The professional accountant shall be honest and not make exaggerated claims or make any disparaging comparisons to the work of others. If the accountant is in doubt, they shall consider guidance from the institute. For tenders, the accountant shall not respond to tender unless the safeguards have been established, such as having qualified staff and disclosing the basis of fees. Next is 260, gifts and hospitality. The threat of accepting gifts and hospitality depends on the nature, value, and the intent of the offer. If it is reasonable, it is permissible. Accountants may perform safeguard to reduce threat, such as keeping the asset separately from personnel and comply with laws regarding to holding of such assets. If it is not possible, then the professional accountant have to reject the audit engagement. Next is section 270, custody of clients' assets. An accountant shall not assume custody of clients' assets unless it is permitted by law. This is because holding such assets may create self-interest threat. If accounted are trusted with assets, keep the assets separately. Accountant may also make inquiries about the source of the assets. This is to ensure that the source of assets are not from illegal activities.
So, let's talk about something else. What do Section 290 refers to?
Well, Section 290 refers to independence of audit and review engagement. This section provides guidance to auditor in maintaining their independence while doing their job, where it includes independence of mind and appearance.
So, when the section is applied,
This section is applied to identify, evaluate significance, and deciding to use safeguards if needed that relates to independence.
now I get it. So, for example, if I am an auditor and I want to engage in an audit engagement with a client, I have to evaluate if there are threats to my independence as an auditor first, right?
Yes, that's correct. And if there are threats, you still can come up with a safeguard to avoid or reduce the threats so that you can accept the audit engagement.
Okay. So, now I'm just curious, how do you evaluate independence, for example, in networks firms?
Network firm formed when a larger firms have a cooperation among entities for profit sharing or share a common ownership or quality control policies or business strategy or a brand name. In network firm, a firm should be independent to clients of its other firms in its network.
So, how about the work of the auditor in reporting his or her professional independent judgment towards a company?
Documentation is very important in this matter because it acts as an evidence of an auditor's work, where all must be documented, including the conclusions of the client's financial statements, required safeguards, and whether safeguards are necessary for a particular company.
Okay, I have a question. What happen if after an audit engagement period ends, the same auditor are offered to audit the same client?
We know that engagement period starts when the auditing activities begin and ended after the audit report is issued. Now, answering your question, if during or after the audit period, the auditor becomes the auditor again for the client, threats to independence should be evaluated before accepting the audit engagement, or whether previous services with the client can raise threat to independence.
Oh, I see. Next, how do independents are evaluated in mergers of companies?
Auditors should evaluate companies that just merged to check whether the independence is still appropriate to the audit company. If the company found a threat to independence after merger and unable to terminate the audit engagement, the company should discuss with those charged with governance. If those charged with governance ask the auditor to continue, the auditor should only continue when the audit engagement can be terminated as soon as possible, or the one causes the threat to rise will not be part of the audit team, or appropriate transitional measures will be applied. If those charged with governance asked to complete work after there are partial completion of the audit work, the company should only do it if they are already discussed the significance of the threat, complies with the requirement of paragraph 290.35 subsection B until subsection C, and ceases to be the auditor after audit report is issued.
So, Mr. Noir, what are the circumstances that can be a threat to the independence of us professional accountants?
There are many circumstances that can be a threat to independence. In terms of relationship with clients, there are financial interests, loans, and guarantees. In terms of employment, there are employment with an audit client, recent service with an audit client, serving as a director or officer of an audit client, and prepare the accounting records and financial statements of the audit client. While in terms of services, there are taxation services, internal audit services, and IT system services. And in terms of remuneration is fees and gifts and hospitality, and many more. These circumstances may create self-interest threat, where the audit team may have interest in the audit client directly or indirectly, depending on the value of the interest. Safeguards may be taken to minimize the threat. If it is not possible, the audit team will have to reject the audit engagement.
Let's talk about Section 500 that refers to the method of practice. How is a member in public practice allowed to practice as a chartered accountant?
That's easy. By his own name, in the name or names of his or her partners, and in the name of a firm. In addition, you are not allowed name of the firm used by other organizations that will disrepute the name of the firm. Next, report or express an opinion based on other person's opinion that is not a member of public practice. Assist any person who practices or hold himself or herself out as a chartered accountant, auditor, tax consultant, tax advisor, or any other like description in contravention of the act. And lastly, practice a partnership with a person who is not a member of the institute.
What if I'm not a member of public practice?
Then you are not allowed to hold yourself to be a member of public practice and provide public practice services such as chartered accountant, auditor, tax consultant, and etc.
Okay, last question before we end the show. What are referrals?
Referrals lies in section 540, where a member receives an assignment by referral from another member. The member that received the assignment should not do the assignment without informing the referring member.
Thank you for making that clear. Well, folks, that's all the time we got for tonight. See you again in the next episode. Goodbye.
Did you ever feel so bad inside?